All right, guys. Today we need to talk about the US dollar. It's still technically the world's reserve currency, but there's a massive shift happening in the global economy, and more countries are moving away from it. To understand why, we have to look at the role of the reserve currency itself. It's supposed to be a stable unit of account and trade, something the world can rely on. But right now, the dollar is sending the opposite signal. The charts are telling us a disturbing story, especially if you're someone who holds dollar assets. Exporters around the world are starting to ask themselves, do we really want to keep greenbacks anymore? Is it worth the risk? Because the truth is, holding dollars right now could end up being a very expensive lesson. Since the start of 2025, the dollar has fallen by nearly 10%, and that's not a small fluctuation. It's a serious move that affects every trade deal, every margin, every settlement tied to the currency. For exporters, that means margins are shrinking fast. What looks like a profitable deal today could easily turn into a loss tomorrow once you account for the currency devaluation. This is why trade in local currencies is skyrocketing. We're witnessing a structural shift in how global business is being conducted. And yes, China is at the center of this move, spearheading what many now call de-dollarization. There's no denying that as China's trade expands, especially with developing economies and its BRICS partners, the reliance on the US dollar is weakening. The greenback is being sidelined, and that is a direct consequence of the ongoing tariff wars and protectionist policies. Punishing the world with tariffs has consequences. The world doesn't just take it lying down, it adapts. And the adaptation we're seeing is a steady, deliberate shift away from the dollar, the exact scenario Washington's policymakers claimed they wanted to avoid. China's export machine is still running hot despite the trade war. Its exports are rising while trade with the US is stagnating. The country continues to post massive surpluses, which means more trade is being conducted in bilateral currencies, not dollars. Beijing is more than happy to accept renminbi, rubles, pesos, or anything else outside the dollar system. That should be alarming for anyone who understands the mechanics of reserve currency status. Here's the bigger problem. The United States is now a hyper-financialized economy. That means it doesn't just rely on producing goods. It relies heavily on its financial system and the global demand for its assets. But the higher US interest rates go, the closer the economy gets to an implosion. We are already seeing bankruptcies among major corporations hit levels not witnessed in decades. Input costs are climbing, inflation is stubborn, and companies are struggling to absorb them. Washington likes to claim that exporters abroad are taking the hit from Trump's tariffs, but the reality is different. Much of the cost is being passed down the chain, and US businesses and consumers are paying for it. Wholesale inflation in the US has surged at the fastest pace in 3 years. Producer prices are climbing well above 3%, and margins are being squeezed across industries. Tariffs were sold to the American public as a way to strengthen the domestic economy, but in practice, they're reversing the disinflation narrative we were promised. If producer prices jump by 2% in a single month, as they recently did, then imagine what happens when those pressures persist for quarter after quarter. Companies have no choice but to pass the costs on to consumers. That means higher prices across the board, from groceries to cars to housing materials. The effective tariff rate today is estimated around 9 to 10%, though some argue it feels closer to 15 or 16% once you account for overlapping duties. Either way, the upward pressure on prices is undeniable. And for policymakers in Washington, this is horrific news. They can't control private companies. They can't stop Trump's tariffs once they're enacted. So the only lever left to pull is monetary policy, and that means sacrificing the dollar itself. Treasury officials have hinted at demanding steep rate cuts from the Federal Reserve, some say as much as 175 basis points. Whether or not that exact number is realistic, the pressure is clear. But here's the catch. Cutting interest rates while producer inflation is rising is like pouring gasoline on a fire. You might provide short-term relief for companies drowning in debt, but you accelerate the devaluation of the dollar at the same time. The fundamentals don't change. Higher input costs remain, tariffs remain, and inflation remains. This is the trap the US economy is stuck in. The Federal Reserve can cut rates to make borrowing cheaper, but all that does is flood the system with more dollars. If the supply of dollars grows faster than the supply of goods, prices rise even further. Consumers swipe their cards more, banks lend more, Wall Street parties harder. But at the core, nothing improves. Goods remain expensive, wages lag behind, and the dollar weakens further. Meanwhile, Washington continues to paint a rosy picture. Trump claims tariffs are bringing in trillions of dollars from other countries. He insists inflation is under control, calling it a beautiful number. But outside the sound bites, the real economy tells a different story. Executives on Wall Street and trade settlement desks are already adjusting. U.S. importers are being asked by foreign sellers to settle trades in local currencies instead of dollars. They'd rather be paid in renminbi, pesos, or Canadian dollars because they fear the dollar will lose another 10% of value. Sure, importers can hedge against that risk, but hedging costs money. Depending on the currency, it can eat up 2 to 5% of the total value of the transaction. For competitive industries, that's enough to wipe out profit margins entirely. Selling to the U.S. in dollars is becoming a gamble many exporters don't want to take. And this is where things get dangerous. A further dollar devaluation doesn't just hurt trade, it threatens the entire global system. In the Americas, nearly 100% of trade is still conducted in dollars. In Asia, it's over 70%. In much of the world outside Europe, it's close to 80%. If those numbers shift even modestly, the market share lost by the dollar will be breathtaking. Every exporter that decides to ditch the dollar adds to the oversupply of dollars returning home, flooding U.S. markets, chasing fewer goods, and driving inflation even higher. This isn't just about trade. Investments are also reacting. Look at Canada's Ontario Teachers' Pension Plan, one of the largest institutional investors in the world. It recently slashed its exposure to dollar assets by tens of billions of dollars. Canadian funds, once among the biggest buyers of U.S. bonds and stocks, are rethinking their positions. Why? Because when you earn 4% on a U.S. bond but the dollar loses 10% of value, you're left with negative real returns once you convert back to your home currency. Investors aren't stupid. They'd rather put that money into local assets, gold, or emerging markets. This is why the dollar is increasingly behaving like an emerging market currency. It's volatile, it's vulnerable to policy swings, and it's no longer delivering the safety premium it once did. With nearly $80 trillion in U.S. assets held globally, the potential for capital flight is staggering. A 10% dollar drop translates into trillions in lost purchasing power for foreign investors. The natural response is to pull back, reduce exposure, and look elsewhere. Treasury officials are trying to soften the blow by issuing more short-term bonds, hoping that rolling over debt quickly will maintain demand. But that strategy only works if investors still trust the dollar. If confidence erodes, even short-term debt becomes unattractive. Rates could remain high on the short end of the curve, no matter what the Fed does. That's a dangerous scenario. Falling demand for treasuries at the same time the government needs to finance massive deficits. Where will that money go instead? Some will head to Chinese bonds, some into euros, and a good chunk into gold. And this is the kicker. Every time the dollar weakens, gold gains strength. During the last 9% slide in the dollar, gold saw heavy inflows. Investors are voting with their wallets, and they're saying they'd rather hold hard assets than devaluing paper. Goldman Sachs and other major banks have already pointed out that the combination of dollar weakness and tariffs is pushing investors into gold and emerging markets. If interest rates are cut aggressively while inflation is still rising, that trend will only intensify. And once confidence slips, it can unravel very quickly. So here's the big picture. The dollar is still the dominant currency today, but its role is being chipped away in real time. Tariffs have accelerated a global push toward local currencies. Inflation is creeping higher. Investors are quietly diversifying out of U.S. assets. And policymakers are trapped between cutting rates to save the economy or holding firm to protect the dollar. Either choice carries massive risks. If this continues, we're looking at a world where the dollar loses significant market share in global trade and investment. That doesn't mean the dollar vanishes tomorrow, but it does mean the benefits Americans have enjoyed for decades. Cheap imports, low interest rates, high demand for their bonds could fade fast. For holders of dollars, the danger is clear. Staying fully in fiat could prove to be a costly mistake. And that's why people are turning to alternatives. Gold, local currencies, even emerging market assets are attracting flows. The dollar is no longer seen as the only game in town. The more Washington doubles down on tariffs and protectionism, the more the world adapts by moving away from it. So the question we should all be asking is, how much more can the dollar fall? Is another 10% decline around the corner? Or could we see an even bigger slide as rate cuts pile on top of tariff-driven inflation? These are not far-fetched scenarios anymore. They're possibilities staring us in the face. What we do know is this: the dollar's aura of invincibility is gone. The system is showing cracks, and global players are already preparing for life after dollar dominance. The longer Washington ignores the reality of rising costs, broken supply chains, and the limits of financial engineering, the closer we get to a major breakdown. That's why, right now, it's critical to watch every move from the Federal Reserve, every tariff announcement from the White House, and every trade agreement signed outside the dollar system. Together, they are reshaping the financial world we live in. So stay alert, because the endgame for the dollar as we know it may not be decades away, it could be much closer. The writing is on the wall and the exit doors are already being tested. And that's where we'll leave it today. The dollar is under siege, tariffs are pushing inflation higher, investors are fleeing to safety, and alternatives are rising fast. The choices made now will decide how long the dollar remains the dominant reserve currency, or whether it enters a slow but inevitable decline. Stay safe out there, because we are truly entering uncharted territory.